Good morning and welcome to the Saxo Bank Morning Call for this Wednesday, November 14th. For once this morning, we can report a fairly quiet equity market session yesterday, but Ole Hansen, commodity strategist, not exactly the case for oil markets or natural gas markets yesterday. Very interesting moves.
No, I think the moves, if we look at the oil now for the past month, just trying to forecast oil at this moment is really a fool's game. We had another collapse yesterday and really a major one, 7% down on the day. We sliced through some key levels of support and the market just continues to go down. As we can see on the chart we brought with us today, we can see this how the 70 level in Brent Crude has now given way, and we're heading towards the lower part of the 60s and potentially all the way down to the trend line coming from the lows back in 16. It really is the complete change in the market sentiment. We've been overwhelmed by supply, especially from the US side. We've seen an increase in production from OPEC, which has not been necessary at this stage. Sanctions against Iran is not going to bite as hard as expected, and these are all just leading to this perception of oversupply. And what really did the damage yesterday was the monthly oil market report from OPEC, where they downgraded the demand for OPEC's own oil for next year, while also increasing the non-OPEC supply, and it just added to these negative headlines we had recently.
There's some speculation. I know Kevin Meir over at the Macro Tourist blog, the macrotourist.com, always has some interesting commentary out there on what's behind some of these moves. He speculated there might have been some kind of emergency exit by some fund that has a natural gas crude oil play on. Do you see anything in that? Or
it smells that way. You can just bring up the chart just to illustrate. You can see how these two markets has moved in complete opposite direction over the last months or so. WTI down close to 30%, natural gas up more than 20%. And this is not natural for natural gas so early in the season, because we had a bit of cold spell. Obviously, inventories are lower than normal for this time of year, but having such a big spike, natural gas has been a favorite short because of the curve structure. It's basically in a contango, so that means you can roll, you can carry on, you can achieve a monthly roll plus just by being short. Whereas in crude oil, you've been accruing a return by being long in the market. These trades are now being unwound. So interesting to see where we. And
if that is the case, you would think that once the bounce does materialize, it could be quite large because the positions are cleared, and then we get back to some more.
Yes, this is no doubt capitulation and panic selling. Longs just getting unwound. I'm sure there's some momentum selling coming into the market as well. But again, we are talking about a few 100,000 barrels changes on, and these are really doesn't really warrant these major moves. But we just see that we see that on numerous occasions. So we need to find the floor. RSI is obviously well into oversold territory. That doesn't really count for much when the market is in a panic mode. But I think we're down the 13th day in a row. So obviously we need to see
the time for this move to come to an end is probably pretty short.
Yeah.
Interestingly, in FX, that move being felt and pretty lightly. Euronoki only up on the order of a couple hundred pips. Canada a little bit weaker, but nothing really notable here. So it really seems to be isolated in the oil markets. However, this is going to feed into the mentality about inflation, and the CPI figures could be digested with a grain of salt on a move like this down in energy prices. It is going to affect the forward inflation levels.
Which could also be one of the reasons why we've seen gold struggling so much these past couple of days. We've seen when the commodity sector generally is under pressure, the whole oil is such a big benchmark for commodities. It puts pressure on the other commodities, but especially for gold if it's deflationary.
And it makes those real rates look even higher if you look down the future, if suspecting that inflation may come down a bit. Okay, the other big news item, and this is a rather big news item, we're seeing a Brexit deal being struck between May's negotiating team from the UK and the EU side. Something like a 400 or 500 page agreement. The first step to the next process is whether May's cabinet will show sufficient solidarity and agree to the Brexit deal, and then it can proceed to a summit later this month, potentially, and as early as November 25th. And then that UK parliamentary vote. I'm actually quite interested in whether, no matter how ugly this deal is supposedly looking, both to the Remainers and to the hardline Brexiters, whether they really have a choice here in the matter and may just sign on to the deal and no matter what. And I think that's what we might see. The market is rather hopeful too. I've got the chart here of euro sterling on a weekly level, where you can see we're at those lows of the range since we went to the new highs back in 2017. And just for perspective, this is a weekly chart. So we saw a consistent lows back in late 2016 around the 83, I think it was 83.50 or so. But the line I've drawn is that pre-Brexit vote high which came in just above 80. So I think that's the type of potential we're talking about in coming weeks if we do see this progressing towards a parliamentary vote. The key issue being that we have the UK-wide backstop that keeps them in the customs union for at least 20 months, 21 months I think it was. So 2 different sources, basically until the end of 2020. I'll tell you, you've got some thoughts on gilts here on this Brexit deal, that this could mean higher gilt yields. I tend to agree, but
yes, so here we have a graph with us that shows the 10 years gilts over the past 5 years. And as you can see, since 2016 until today, the gilts yields have been trading range bound between 1%, 1.7%. So if today we see the cabinet approving the Brexit deal that May has prepared for them, we might see yields going higher. And the reason being is that in the UK there has been this cloud over the UK economy, which is the Brexit, and the BOE have effectively never hiked, or at least it hiked recently, but it basically hold its hiking path. So investors, if an agreement is going to be reached, the investor would assume that the BOE will continue with the hiking path, rate hike, and what we will see is possibly the yields overcoming the 1.7% trend line and possibly stabilizing around the 2%.
Yes, and I think definitely a Brexit deal will allow the Bank of England, given that the output gap is essentially back to neutral and even going into positive, suggesting a slightly overheating economy, that they'll be hiking rates quicker, even though they said they're going to hike under any scenario. I think obviously a reasonable soft Brexit scenario sees more hikes quicker. Finally, on the FX side of things at least, I wanted to point out Eurostocky. I've got a chart here showing that we saw some progress lower in Eurostocky. This is a key development, technically breaking that, or sort of confirming that break below the 1030 line and the 200-day moving average, which you're seeing here. We see a CPI data point up this morning from Sweden. You just get the sense, based on what the Riksbank is saying, that they're progressing towards this series of rate hikes and that policy unwind, given how cheap the stocky is in CPI-adjusted terms on a historic basis. I think we have a reasonable trend developing here. Again, today's key with the CPI figure, but this break looks key, and I think we could progress towards the 10 level, 10 spot 10 to 10, the big figure level in Eurostocky. Now I want to take us over to corporates. We've talked a lot about corporates as a potential area for the systemic style risks in the market, and even specifically that GE story, which we saw an interesting bounce in GE yesterday on a deal to unload some Baker Hughes assets. But I'll tell you, you've brought a chart here today of the where we're seeing the pain in corporate bond markets, because the corporate bond market is not just one big entity. It's got many slices, if you will, of where the debt lies. So what's your spin on this chart here?
So we have a chart here that shows that the U.S. investment grade corporate debt has been performing the worst since 2008. So a lot of people now are asking whether this is another sign, apart from the flattening of the yield curve, that this late economic cycle is coming to an end, and possibly we are getting into a recession. Well, in order to answer this question, I believe that it's important to understand exactly what is happening in the U.S. investment grade corporate space, and we have here another chart showing basically unboxing the high grade corporate space, and in the blue line you see the AAA credit spreads against the treasuries, and in orange the BBB rated corporate spreads against the treasuries. And what you can see is that while the AAA since the beginning of the year until now, the spread has been basically is tightening in a certain way. The triple B corporate spreads instead are widening. So the real question is, are the triple B corporate, triple B US corporates going to go bust soon? And I believe that there is much more into this topic, and it might not be looking too good for them, but it doesn't look like it's going to be something systematic. And the reason being is that the triple B rated, the triple B space has been affected by rising interest rates, but also by an overwhelming activity in merger and acquisitions. And also in the example that you made with General Electric, I believe that General Electric is the best example so far about these risk that all the triple B companies are going through. GE basically went through an acquisition of Alstom in 2014, and they bought this company by issuing a lot of debt, and the balance sheet got very much leverage. However, GE has been trading let's say, the price of GE bonds has been supported until now. And I believe that bond investors at the moment are basically selling the debt just because they are realizing that interest rates are rising. So over-leveraged companies like GE that belong to that lower rated investment grade space are gonna be basically have difficulties.
So specific stories could see some default scenarios or worsening default risks, but not necessarily the whole space.
More downgrades than defaults at the moment. I believe that the defaults we will see them in the high yield space more than the investment grade space.
Right, but default risk rising. I didn't mean actual defaults, but yes, default risk rising. Okay, that wraps up that bit, and we'll look at our calendar for today. Ola, I wanted to go to you first on the calendar because we have this monthly report. I mean, obviously, if we're talking about panic deleveraging of positions, maybe this isn't a big, but it's a test for the market nonetheless.
Absolutely. We had OPEC out yesterday, and then later today, I believe it's at 10 o'clock CET, so 9 GMT. We're going to have the monthly report out from the IEA. They are these reports are obviously attracting more and more focus now, especially with these emerging downgrades to demand into 2019. So it's interesting to see their take on it. And also just mention that the weekly stock report is delayed by 1 day, so that will be out tomorrow.
All right, and then otherwise on the calendar today, 3 CPI figures. Again, that Swedish one we'll be looking at for to confirm that Euro stocky break lower. UK CPI is going to get ignored more or less as we wait for that UK government cabinet meeting. Is apparently starting at 2 o'clock GMT, also British Standard Time there. Of course, no idea when the actual announcements start to emerge from that meeting, and we'll look at whether key cabinet ministers are announcing their resignation or lack of support for this Brexit deal. If enough sign on, then I think it'll be taken as another positive leg for sterling, and then we wait for the noise on whether this parliamentary approval vote can go through and the timing of that. Otherwise, US CPI was also important. Again, as we talked about a while ago, some of that CPI data is now going to be discounted because of this massive slide in oil prices. Chairman Powell out speaking much later today, almost in Asian hours. And of course, as we've been talking about all week, we're waiting for that Xi-Trump meeting or summit at the G20 either on November 30th or December 1st. That's it for today. We'll be back tomorrow.